what do you make of where we are at the moment? Clearly, the markets have front-run the recovery. Too much? Do we need to talk about bubbles?
Well, so let's just talk about the labor market for a second. Yeah, the numbers are somewhat disappointing from what the expectations were, but we got to sort of look at the trend. The trend's been pretty strong. We continue to see labor recovery. Unemployment continues to drop. It may not be moving at the speed that we want, but I think you had a guest on earlier, and I think he said it well. If you had looked at the labor construct today, back in March, you would have said, this is terrific. And I think that you're continuing to see healing in the labor force without, by the way, recovery in the leisure industry or the travel industry, and that is going to come later in the year. So that gets you back to the market. The market's basically said, look, I think there's a recovery. I think the recovery will be strong. I think the values and earnings growth are going to be strong in the fourth quarter, following through to the first quarter. The real key issue is, what does the market say 6 to 9 months from now? Because a lot of the stimulus is already in the price. The Fed's stimulus is in the price. And so how much more stimulus are we going to have? Not much. We need to see earnings growth. We don't know how much earnings growth we're going to have. Companies are anticipating that they'll have strong fourth quarters, but they're not saying a lot about the future and the end of 2021, looking into 2022. So I think the market feels strong here. I think it will probably continue for some bit, but there are definitely indicia of bubbles, and you've got to pay attention to those bubbles. And the market could easily have a consolidation of 10 to 15%, and nobody should be surprised.
Well, speaking of bubbles, right? Everyone is talking about only concentrated parts of the market with bubbles. How do you protect yourself from those parts of the market? How do you even hedge when you saw a week like last week where short sellers were getting squeezed left and right? What's the answer?
Look, there is no effective way to hedge yourself in the short squeeze of last couple of weeks. You know, from January 20th to January 27th, that was a pretty challenging time to be hedged. The key issue in those markets is not to be forced to sell. And what created the calamity in that market is there were too many investors who were forced to sell because they were over-levered. Either short sellers had, a huge short positions on relative to the underlying stock, or they had too large a gross position and they had to effectively liquidate. Liquidation is, in effect, extremely expensive. So a natural investor who can hold stocks over time with a small amount of leverage or no leverage, they're in the strongest position. There is no hedge for that kind of activity, but there is the avoidance of the leverage.
Back to the stimulus talk, right? Market levels. Now that we have more information here, you said before, many people had said that inflation was going to be something that could start to really make an impact here at some point. How concerned are you still about inflation? At what point do we start worrying about it?
Well, I think you should worry about it. Look, right now we have what we have continued to have for the last 2-3 years, which is negative real rates. If you look at the 10-year rate and you subtract out whatever your estimate is for inflation, you have negative interest rates. Negative interest rates are very strong elixir for a stock market, and we've seen the effect of that. 10-year rates are going up, but more importantly, what is happening to inflation? And as the job market heals and as we come out of the pandemic, and you have to realize the amount of stimulus that the U.S. government is going to actually put into the economy is likely to be north of $5 trillion. The Fed's balance sheet has doubled from 4.3 to almost $7.4 trillion. That's a tremendous amount of stimulus. That all can happen without affecting inflation. And as inflation rises, real rates could actually turn positive. And that will be a impact on those stocks that are overvalued as a result of negative interest rates. That is going to happen.
Well, Peter, the argument of the Biden administration is that you can't go too big on stimulus, that it's not really possible. Is what you're saying that it is, in fact, though, possible to overshoot that, put too much money into the economy?
Well, there's a political statement about you can't go too big. And I think that that's a statement about saving people who have lost their jobs, have no income, could be thrown out of their place of living, aren't able to eat, you can't go too big for those people. That seems right to me. That's a fiscal policy, a social policy. The question you're asking, can you go too big for the market? The answer is yes, you could drive inflation beyond what everybody's target is. But remember, you have the Fed saying numerous times from numerous people in the Fed group, including Yellen, that they're going to look to actually overshoot on inflation. They're going to look for the market to run a little hot because inflation has been so tepid for so long. So I just think we have to be ready for inflation to actually run over the Fed's target, that the fiscal stimulus is going to be big, and it's going to actually drive inflation. It's going to drive real rates up. And you have to think about what stocks do I want to own in that environment.
OK, let's talk about what you might want to not own. Would you own government bonds at this point in time? And how much do you think is left in the credit story?
Yeah, the credit story is a tough story. Look, duration is the most expensive it's been in 30 years. If you go back to the 80s and you look at where the 10-year rate was, it was 15% at the height of inflation. It's dropped to, where it is today, let's call it 100 basis points. That's not going to happen again. It's just not. The 10-year rate is going to go up over time. So if you own duration, it's going to be expensive. Now, oftentimes, you get a benefit as economies heal and they get stronger and credit spreads tighten. But credit spreads are already tight. So it's unlikely you're going to get tightening in spreads. And it's highly likely you're going to see duration actually get expensive because rates are going to go up. So bonds are very expensive to hold. That's part of the reason why people own equities.
On that note, I was speaking to a money manager yesterday that made the point that people are just crowding into too much credit risk. And that's really the only trade in town. Do you think, I know you've been critical on fees and active management, especially on the equity side, do you think people are paying their credit managers too much money?
Look, my whole view on fees to active first of all, let me just back up and say, I think active management works. I think it has to be capacity constrained. And I think you have to have a fee that's aligned with the manager producing a return in excess of the index. The challenge in fixed income has always been that the indexes are not very efficient, and it has been easy to beat the indices. That has become more difficult. So do I think you should pay your manager a base fee that's equal to the index value and a performance fee to beat the index? Absolutely. That's what Aperture does. Do I think you should pay them fixed fees? No. I think you overpay them when you pay them fixed fees, whether it's equities or fixed income.
So do you think fees then in this new environment are just bound to come down a lot more, despite all the talk of active management having a resurgence?
It doesn't help for fixed fees to come down. You end up with the same problem. The manager is always incentivized to gather more assets. If all you do is pay them based on assets, then they'll just go gather assets. And the more and more assets you have, the harder it is to perform. That's a fact. So the fee structure, if you really want to pay the manager to perform, pay them to perform. Don't pay them to just hit the index.
Can we talk about the democratization of investing? That's what a lot of people have been talking about in this Robinhood Reddit saga that we've seen playing out, that the fact that you can make trades for no money makes the cost of taking risk really low. And as a result, that may expand risk more broadly into the market. What do you think about that? Is the cost of taking risk too low?
Yeah, what is the cost of taking risk? The cost of taking risk is primarily the price variation of the asset that you buy. It is not the brokerage cost or the commission to acquire the asset. If you think about it, if I buy a stock for $100 and it costs me 10 cents to buy the stock, if the stock moves 1 point, that's $1. That's 10 times the cost of buying the stock. So the cost of buying the stock, if people think that's the cost of risk, that's just wrong. The cost of risk is the price volatility that's associated with the assets that you own. That hasn't changed. That's still actually pretty volatile. And you can certainly see that in the movements in markets when they get really erratic, which they were, in late January. So I don't think the fact that the cost of trading has dropped is necessarily a bad thing. I think it's a good thing. I think the key question is, what is the investor taking on as risk, and do they understand the risk that they're taking?